A few months ago, I was working with a buyer. We found a home. They loved it. We wrote an offer and I got it accepted. They had a pre-approval letter from the bank, so everything should have been great, right? Wrong. 2 weeks prior to closing the escrow, the lender called me and said, Michael, the underwriter said we can't do this loan. I asked why not. He said their debt ratio was too high. I said, why didn't you know that before we wrote the offer? He said the underwriter found some income that didn't count. Here's the kicker. Had they gone with a direct lender, that might not have happened because a direct lender has more flexibility. In today's video, we'll take a deep dive on the best ways to get the best loan for you so that this never happens. But before we get started, do me a favor. Like the video. It tells the algorithm that you want to see more videos on residential real estate. Leave comments. Let me know what topics you'd like me to cover and what you feel about today's video. If you like the content, subscribe to the channel. We're growing and we appreciate everyone who joins the channel. Remember, like, share, and subscribe, and here we go. Part 1. Mortgage mistakes that could cost you thousands. The biggest mistake that you can make when you're looking for a home is the mistake that almost every home buyer makes. They shop around every mortgage broker, every bank, every lender until they find the lowest possible interest rate, and then they get pre-qualified and or pre-approved with that lender. And now that they're pre-approved with that lender, they find a house they like, they write an offer, they get into escrow, and the problem is that the process has just started, and they don't even know if they can actually get the house or not. That's a huge problem. The other issue is, since you don't know what the interest rate is based on the pre-approval, by the time you write the offer, your monthly mortgage payment could be much higher than you're expecting, and that could cost you thousands of dollars. Part 2. FICO Score Secrets that the bank does not want you to know. So here's something I bet you didn't know. Did you know that you can pull your credit report up to 3 times within a 30-day period, and the credit bureaus will look at it as one pull? That's right, one pull, as long as it's for the same thing. So for example, if you're looking to buy a car and you go to 3 different dealerships and pull your credit 3 times, the bureaus know that you're shopping for a car and they look at it as one pull. The same is true with a mortgage. And the reason the banks don't want you to know that, because that's the number one reason that most home buyers will not switch lenders even if they're not happy with the service or they feel like they could have gotten a better rate, because they don't want their scores to go down by pulling their credit again. The fact is, it won't. So you should look for a lender who gives you the best rates, terms, and service. Service is critical. Your credit score will generally go down about 3 points for a credit pull on a hard inquiry. So what score do you need to qualify? In today's world, for a conforming loan, you need a 620 FICO score or better. And there are government programs where you only need a 580. But if you have a 740 FICO score or higher, then you will get the best rates at the best terms. Part 3. Pre-approval versus an actual approval. This is one of the best tips I can give you. Most buyers, when they start looking for a home, get pre-qualified for a loan and or a pre-approval. And the truth of the matter is, it's the same thing, and it doesn't mean very much, because a pre-qualification and a pre-approval is not really worth the paper it's written on. They still have to go through underwriting and make sure that you actually qualify. They're going to ask you for so much documentation and paperwork, you're going to think that you killed a small forest. So my advice to you is, get an actual approval. That's like having a credit card to buy a house. It puts you on par with a cash buyer. It takes more time, that's true, but it's absolutely worth it, because then you won't have any surprises at the end and you can make a much stronger offer to buy your home. That's the difference between a pre-approval and an actual approval. Part 4. Banks, mortgage brokers, direct lenders. What's the difference? This is a huge issue, and I tell my clients all the time, not all lenders are created equal. Banks are where most people think, it's a bank. You should be able to make a home loan. What's the problem? Well, it turns out that banks like Bank of America and Wells Fargo and Citi and Chase are probably your worst option. Why? Because they're too big and you're just a number. And if you don't fit within their perfect little box, getting a loan may not be as easy as you think. And as I said before, you have a finite amount of time to get an actual approval. So if that's the case, you want a lender who can absolutely do the loan in the time frame specified. And a mortgage broker, what's the problem with a mortgage broker? Their job is to get you the absolute best rate that they can find. So what's the problem? I'm saving money, right? Wrong. First of all, the mortgage broker will go to the banks. It's just their wholesale division. The second issue is much bigger. Lack of control. Once the mortgage broker submits your loan to the bank, they lose all control. So what's my recommendation? A direct lender. What is a direct lender? A direct lender is a bank, but all they do is mortgages. And they're usually local. And their money, their underwriter, their documents, their processor, everything is in-house. They're streamlined. They're designed to do mortgages. And that is your best bet by far. They have their own product, their own schedules, and their own way of doing things. They usually have more flexibility, and they usually can do a better job than just about any other source for mortgage loans in the industry. Direct lenders, that's the way to go. Part 5. How to avoid the biggest mortgage mistakes. Don't shop around for the best interest rate. You're looking for the best lender. The lender that can do what he promises he can do in the time he promises he can do it. It's not important, it's critical. And generally, when you're looking for the best rate, maybe you save 50 or 70 bucks and maybe you don't. But if you don't get the house, what does it matter? Have all your documents in order. It will save you a lot of time and a lot of headaches, and that way you won't have any surprises. So what are you going to need? Well, you're going to need 2 years tax returns. You're going to need paycheck stubs. And if you're self-employed, you're going to need your K-1s. And if you're a salaried employee, you're going to need your W-2s. Don't move money around. The lender's going to want to know where every dollar came from. Don't make large purchases. Not time to buy a car. After you get the house, you can do whatever you want. But until you get the house, don't do anything that could affect your credit score, which brings me into the last point. If your credit score is a 620 or better, don't worry about paying down debt in order to get a better interest rate. You're only going to be saving about $50 to $70 per month, and you can always refi when your credit score goes up. So don't use that money to pay down credit cards. It may not help anyway. And lastly, don't rely on sites like Credit Karma to know where your credit score is. That's a generic score. And what most people don't know is there are different types of scores. There's Vantage and there's FICO. Some lenders use FICO, some lenders use Vantage, but they all have models that are built around a mortgage. So you won't know what your credit score really is until the lender does his try, merge, pull. And they'll take the high score, they'll take the low score, and kick them out. Your middle score, that's your score that the lender will use to approve your loan. Leave a comment below and let me know what you think. Did you know that? So in conclusion, the best lender is not the lender who quotes the lowest rate. He or she is the lender who can deliver a competitive rate and do what they promise they're going to do when they promise they're going to do it. Because time is not your friend when it comes to a mortgage. Remember, you are competing with other buyers. Some of them have more money, some of them have better credit. But it is a competition. and the buyer who has the best lender, the lender who can actually deliver, the buyer who has an actual approval, a credit card to buy a house, the buyer who has the better realtor, the buyer who is positioned to win will almost always come out ahead. And that's how you get it done. Well, that's the video. Thanks for watching. Let me know below if you've ever had problems trying to get a mortgage, or if this information was helpful and useful to you. There are links below to resources that can help you with getting a loan or real estate. Remember, like the video. It tells the algorithm that you want to see more videos on residential real estate. Subscribe to the channel. We're growing and we appreciate it very much. Remember, like, share, and subscribe, and we'll see you next time. I'm Michael Barish. Click here for more videos on residential real estate.